This is Nightly Business Report with Bill Griffith and Sue Herrera.
Where's the panic? It's been a dramatic week on Wall Street with sharp declines, yet investors are relatively calm. Is that a sign that the worst is still to come?
Shop till you drop. With Black Friday just 2 days away, retailers are taking steps to drive sales and alleviate concerns about weaker margins.
And locked in, Cyber Monday is fast approaching, but there is one segment of the online shopping area coming under fire. It's a story you need to see. All that and more tonight on Nightly Business Report for Wednesday, November 21st.
And we do bid you good evening, everybody, and welcome. It's a good thing that Thanksgiving feast is tomorrow because there's been plenty of stomach-churning action already on Wall Street this week. And today was no different. Stocks did open this morning looking ready to recoup some of the week's losses as we head into the holiday weekend. Technology was holding up. In fact, many of the beaten down stocks in that group, like Amazon and Facebook, even Apple, were trading higher. And the Dow was up more than 200 points for a time. But then things changed late in the day, and Dow component Apple gave up all of its gains and dragged the industrial average down with it. Good news, the NASDAQ and the S&P did stay in the black. Final numbers for this Wednesday. The Dow down just a point, still below 25,000. The NASDAQ rose by 63 and the S&P added 8. So as yet another rally fizzled, investors have to be asking themselves whether this is a market that just wants to go lower. Mike Santoli looks at whether there's enough fear yet in the market to help find a bottom.
Wall Street's two-month slide has certainly made investors a bit anxious about the market outlook. But there has not been the kind of intense panic or urgent flight from stocks that many traders like to see before betting that a good bottom for the indexes has been reached. As the S&P has fallen 10% from a high for the second time this year, retail investors have pulled significant sums out of stock mutual funds and riskier bond funds. Traders of stock options have been more aggressive, buying protection against further index declines, and surveys of individual and professional investors have also shown a decline in bullish sentiment in recent weeks. But so far, these responses have stopped short of true extremes of fearful attitudes and behaviors that often accompany a durable market low. The market's volatility index, for instance, a measure of demand for downside option bets, peaked in the high 20s in October, but in the past week has stayed closer to 20, even as the S&P has approached October lows. And Wall Street strategists, on balance, continued to predict some recovery in stocks by year-end and further modest gains in 2019. It's important to note that not all market rebounds happen only after most investors have fled or given up hope. Perhaps with the S&P still roughly flat for the year and the U.S. economy still performing well for now, the level of caution among investors now isn't out of step with current conditions. And the prevalence of automated trading strategies dominating the day-to-day action, there's a chance fear readings are less frequent or clear than they used to be. Though, of course, humans still decide whether to give machines the money to trade. Could it be that with nearly half of all stocks down 20% or more and bond yields easing back from their highs, the market maybe can find its footing without first scaring most investors away? Well, old-time traders might prefer to see more panic before buying, but perhaps that would require another plunge to new lows, which may or may not be ahead. For Nightly Business Report, I'm Mike Santoli.
Orders for durable goods like washers and dryers fell more than expected last month, although much of that was driven by weaker demand for airlines. Orders fell nearly 4.5% in October. It was the steepest decline in more than a year. The report also showed that business investment fell slightly, adding to drops in August and September.
Right now, there's a divergence of opinion between Wall Street traders and economists about where this economy is headed. Will it be a slight slowdown or worse? Steve Leisman takes a look for us tonight.
The U.S. economy is coming in for some sort of landing, with economists forecasting a soft one and traders seeming to believe it's going to be a bumpy ride to the tarmac. U.S. growth is seen slowing from a high of 4.2% in the second quarter to 2.8% in the fourth, and then to 2.4% in 2019. Slowing global growth, trade wars, higher interest rates, and a decline in fiscal stimulus are all weighing on the outlook.
The market's down about, at worst, 10% from its peak. Given higher interest rates, given the trade war, given the slowing of growth, I think that's all should be expected. So I don't think it's signaling a dramatic weakening in the economy, but certainly a slowing.
Today's U.S. durable goods report for October supported the idea of a slowing. Business investment fell for the third straight month. That hasn't happened since 2015. Lower oil prices, which have reduced spending in the oil fields, and tariff fears may have caused some executives to push off investment. One wild card for 2019, will the Fed react to the slowing by itself slowing down the pace of rate hikes?
I think the market is questioning whether the Fed has to be as assertive or aggressive as it is currently postured. I think that is one thing the market, but that can change in the blink of an eye, right? You could have a change in policy, a pause indicated by our Fed, and markets could very quickly get comfortable with that. We think that the trade war is much more difficult situation to resolve potentially.
So far, economists have marked down growth but haven't called for a recession. Judged by the strong downdraft in stocks the past several weeks, it seems at least some investors have made up their mind that one is coming. For Nightly Business Report, I'm Steve Leisman.
Let's hear a bit more now from Mark Zandi on how much of a slowdown he expects to see in the economy. He is the chief economist at Moody's Analytics. Good to see you, Mark. Welcome. Let's start.
Thanks, Sue.
Let's start, first of all, with what indicators you're going to be watching that might tell you what type of a slowdown it's going to be, because obviously, from Steve's piece, you do expect the economy to continue to slow a bit.
Yeah, I do. I mean, I think the economy was all juiced up earlier in the year by deficit finance tax cuts, and the benefit of those tax cuts are now fading. So it's not surprising that growth would slow. But to gauge how much the economy is slowing, whether it's a serious slowing or even recession, things I would look at would be, for example, the number of initial claims for unemployment insurance. That comes out every week, very sensitive. Right now, it's between 200 and 225,000 per week. That is very low, very consistent with a solid economy. If that starts rising back closer to 300,000 per week, then that would be a sign that something's really coming off the rails. Consumer confidence, also, that's a very good. Usually, that reflects the economy. It doesn't drive the economy, but if things are turning and we're starting to go into a downturn or recession, then confidence gets hammered, falls very sharply, and it starts to affect the economy. So I'd watch that as well. And finally, one other indicator, a little bit more esoteric, something I watch is construction and loans to businesses, C&I loans, construction and industry loans. They're a very good barometer of the health of the economy. A little bit lagging, but something I also watch.
And what do you think the Fed will do about this? Clearly, a spotlight has been focused on them. Some people blame them for the slowdown we're seeing right now with the rate increases. And just this week, Wall Street started to anticipate that maybe they won't raise as many rate increases next year as had been anticipated earlier. What do you think they're going to do?
Yes, some blame, like the president, you mean, blames the Fed and the higher interest rates for the slowdown. Yeah, partly. I think the slowdown, as I said, is really largely related to the end of the benefit of the tax cuts. That provided a nice pop to growth. People went out and spent that extra tax benefit, but that's gone, and that we don't have that. I think the trade war is also playing a really big role. You mentioned those investment numbers. They've kind of gone sideways here in the last few months, despite the lower marginal rates for businesses. And I think businesses are very nervous about how this trade war is unfolding, and I think it's affecting their investment decisions.
But do you think
and of course, the higher rates also matter.
Do you think the Fed could be, and I hate to use this word, but really this is what comes to mind. Do you think the Fed could be bullied into not raising rates as many times next year as they would otherwise?
No, absolutely not. No. I mean, I think they got a script, right? I mean, and they got a formula, almost a formula. They look at the unemployment rate, where is that relative to full employment, where the 3.7% unemployment is falling. They look at inflation. They have a target, 2%. We're right on target. They look at financial conditions, what's going on in the market, and credit spreads and cap rates. But, I just don't think there's any possibility they're going to bow to those kind of pressures.
Okay. Mark, we have to leave it there. Thanks for joining us. Happy Thanksgiving.
Thank you.
Mark,
yeah, you too. Take care.
Mark Zandi with Moody's Analytics.
Existing home sales rose in October for the first time in 6 months. Sales of previously owned homes rose just under 1.5% to a seasonally adjusted annual rate of more than 5.2 million. Now, even with that increase, sales for the month were still down more than 5% compared to the same time last year. Separately, fewer potential home buyers applied for a mortgage last week, and applications for refinancing, that fell by 5%.
The once red-hot housing market, the house flipping market specifically, may be flopping. A combination of higher costs and lower housing demand has some flippers fleeing. Diana Olick explains.
Mark Bethanis has been flipping homes in the Los Angeles area for 30 years, usually several per year. But this year, he did just this one.
It's not only becoming more expensive on the purchase side of flipping, but it's becoming more expensive on the fix-up side of flipping.
Bethanis is a residential contractor, but even he has had trouble finding labor to transform his flips like this and finding homes cheap enough to profit on. The math is getting a lot tighter. And that is likely why the number of home flips, defined as a home bought and sold within the same 12-month period, fell 18% in August nationally compared with August of 2017, according to Atom Data Solutions. In California, where prices are high and demand is falling, the number of flips was down a steeper 22%. Gross flipping returns across the country in August fell to the lowest level in nearly 7 years. And it's also taking much longer to sell a flipped home. Now an average 186 days, the longest since June of 2006. There is also increased competition from large-scale flippers who came in during the foreclosure crisis and have continued to flip large volumes of homes.
They have teams of people, looking at properties, where the little guy like myself, as an example, I have myself and my realtor contacts that are looking, but, a team can always do more than an individual.
Flippers are also now faced with a cooling housing market where prices are still high, but demand is falling off because of higher mortgage rates. And a lot of older homeowners who might be downsizing now are staying put because it's so expensive to move. That leaves fewer flippable homes ripe for the picking. For Nightly Business Report, I'm Diana Olick in Washington.
Mark Zuckerberg is staying put. During an interview last night with Lori Siegel on CNN's AC360, Facebook's chairman and CEO defended his C-suite. He called Chief Operating Officer Sheryl Sandberg an important part of that company. He also said he's planning to keep his chairman's role.
So you are not stepping down as chairman?
That's not the plan.
That's not the plan. Would anything change that?
I mean, like eventually over time. I mean, I'm not gonna be doing this forever, but I certainly I'm not currently thinking that makes sense.
Zuckerberg also reiterated points that he has made in the past. He apologized for many of the missteps that have plagued his company, most prominently Russians using Facebook to meddle in the 2016 election.
Coming up, happy travels.
It's a holiday treat for those flying on Thanksgiving weekend. Few delays and a smooth travel experience. I'm Phil LeBeau in Chicago. That story coming up on Nightly Business Report.
Following the arrest of Nissan chairman Carlos Ghosn, questions have arisen about what might happen to the alliance that he built between Renault, Nissan, and Mitsubishi. Sherry Kang is in Yokohama, Japan, with more on the challenges for the automakers.
The Japanese government calling for a stable automotive alliance among Renault, Nissan, and Mitsubishi. Japan's Chief Cabinet Secretary Yoshihide Suga saying that it's important to keep this three-way alliance alive. Now, this is really the moment where the interests of the French government and the Japanese government seem aligned here. But really, the crucial question is, what does a Nissan Motor want amid reports of frustration on its part regarding the structure of this alliance, with Nissan Motor having no control over its French partner and no voting rights. In the meantime, though, the Japanese automaker might have its own prosecutorial problem, with Asahi Shimbun reporting that the prosecution in Japan is considering to make a case against the company itself amid allegations of financial misconduct of the chairman and a board member. Tomorrow, Thursday Asia time, is really the big day for Nissan Motor, with board members gathering together and voting on the removal of Carlos Ghosn as chairman. For Nightly Business Report, I'm Sherry Kang in Yokohama, Japan.
Many Thanksgiving travelers are already on their way to Grandma's house, and this year a record number will be getting there on a plane. Phil LeBeau has more on why flyers are finding packed planes and higher fees. He's at Chicago's O'Hare Airport for us tonight.
It is one of the busiest days of the year to fly, but around the country, travelers are enjoying a relatively smooth journey.
It's pretty calm. It was easy coming in, too.
I was shocked because I was going to take a cab because I didn't think there was going to be any parking, but there's plenty of parking and it's empty.
It should be crowded, but it's much calmer today.
We thought it was going to be a disaster, but we were really pleasantly surprised when we just got out of the taxi.
This year, there is good news and bad news for those who are flying. On the bright side, airlines are doing a better job with planes taking off and landing on time, and there are no major storms to ground scores of flights. On the other hand, travelers are generally paying more to check bags, with several airlines recently raising baggage fees by $5.
There may be a little bit of grumbling, but I think given the strong demand and the tight supply that does continue throughout the industry, we are seeing travelers, willing to pay that.
Analyst Susan D'Onofrio has been tracking airfares, and she says they've gradually moved higher over the last couple of months, roughly 5%. And because of the strong economy and healthy consumer confidence, travelers have been willing to pay the price.
I would say overall, we're going to see a very busy weekend. We've been seeing a very busy fall. And I would say in terms of what we're anticipating, we're expecting volumes to be up about 5%. And with that, we are expecting pricing to be up about 3% as well.
All of this is good news for the airlines and their investors. The packed planes, higher fees, and slightly higher airfares means this could be a very profitable holiday season for the carriers. Phil LeBeau, Nightly Business Report, Chicago.
Sales picked up at Deere, but not at the pace that Wall Street was expecting, and that's where we begin tonight's market focus. The equipment maker reporting disappointing results for the quarter, even as demand for farm and construction equipment improved. Deere said it expects margins to expand next year, but also sees overall profits coming in lower than expected. The shares finished up more than 2% to $141.88. The software firm Autodesk grew its subscriber base, and that helped results to top expectations. Autodesk also said it was buying a startup for nearly $900 million that it says will give it the opportunity to make workflows in the construction industry more effective. Shares of Autodesk jumped nearly 10% to $135.04.
GameStop said today that it is selling its Spring Mobile business for $700 million. Spring Mobile owns and operates more than 1,200 AT&T wireless stores. Video game retailers said that the deal is going to generate immediate cash and allow it to focus on its entertainment business. Shares popped more than 11% on that news today to close at $13.71. And an appeals court has rejected Johnson & Johnson's request to block generic versions of its prostate cancer drug Zytiga from hitting the market. The drug maker had asked for that halt while it appeals a judge's ruling invalidating a patent on that treatment. J&J now says it will seek an emergency order to stop those generics. Shares fell 3% today to $141.99.
Black Friday, of course, is a critical day for retailers. So in order to handle the crush of shoppers, many are prepping today to make sure things go smoothly on Friday. Courtney Reagan is at a Kohl's in Secaucus, New Jersey for us.
Retail workers around the country are getting stores ready for the biggest shopping weekend of the year. More than half of all Americans are expected to shop online, in-store, or both at some point between Thanksgiving and Cyber Monday. While Black Friday is not as big as it once was because of sales spread over the weekend and online, it's still expected to be the biggest day of the year.
Friday's turned into an event with families and friends where it's more of a tradition. So families spend a lot of time out together on Black Friday. Actually, when we talk to the consumer, about 25% expect to shop on Thanksgiving. About 70% expect to be in the store on Black Friday.
Pretty much we eat turkey, eat, and get the girls ready, and let's get out and shop.
I'm definitely not shopping Black Friday. I'm not shopping over the weekend either.
I'd rather do everything online.
If you want to get a head start, most retailers are offering doorbusters online very early Thanksgiving morning. But if you want to hit the stores, JCPenney opens first at 2 p.m. on Thanksgiving Day. Best Buy, Kohl's, Macy's, and Target store deals start at 5 o'clock. Walmart's Black Friday begins at 6 p.m. at its stores, but you can get fueled up starting at 4 o'clock with free coffee and cookies. It takes a lot to prepare the supply chain, stores, and website to handle the Black Friday surge. Getting the right merchandise in the right quantity to the right stores and distribution centers is often planned a year in advance. Apps and websites are tested under heavy volume to make sure sites can handle the traffic. Beyond offering enticing prices, retailers are aiming to make shopping easier. Walmart, Target, and Kohl's have mapped all their stores for shoppers so doorbusters can be found quickly. All three are also offering the option to check out without having to go to a register at least some stores. Buy online, pickup in store becomes even more important during the holidays. While it gives shoppers flexibility, it adds complexity for the retailer to use store inventory and labor to also quickly fill online orders.
Kohl's says most buy online, pickup in store orders are ready in an hour or less. The department store expects 10 million items will be picked up in store in November and December alone.
Retailers have been working since last Christmas to get everything ready for this weekend. Now all that's left to do is wait for the shopper rush.
And you have a wonderful Thanksgiving.
Thank you. For Nightly Business Report, I'm Courtney Reagan in Secaucus, New Jersey.
Good. Coming up, there is one industry where top companies earned billions last year. So why is it under fire? Amazon said today that some customer names and email addresses were exposed due to what the company called a technical error. Amazon says the issue has been resolved and the company has contacted those customers who were affected, but they are not saying how many or how long that breach lasted. Meanwhile, the Postal Service says it has fixed a security flaw on its website that allowed anyone with a USPS.com account to view the details of about 60 million other users.
Shoppers spent more than $6.5 billion online last year on just one day, Cyber Monday. Some of that money going to online subscriptions. The model where you sign up for a monthly box or service is booming, but some businesses are under fire with the feds now cracking down. Andrea Day with our investigation, Locked In.
Hi, I'm Morgan Herman-Wage.
He's the founder and CEO of Adore Me. We first heard about the company on CNBC's Power Pitch nearly 4 years ago, a segment where entrepreneurs get to pitch their business models to a panel of experts.
I am not a fan of customers going to the website and being defaulted into a subscription model instead of proactively choosing it, so unfortunately I'm out.
Subscription e-commerce programs like Adore Me's, where you're charged every month to receive products, are booming. According to a recent study by McKinsey, the market growing more than 800% from 2013 to 2017. The top companies raking in more than $5.5 billion just last year. But when it comes to the plans, consumers can lose out.
We continue to monitor this area for fraud because it's an area that's rife with problems right now.
James Combe is the Assistant Director of Enforcement at the Federal Trade Commission's Bureau of Consumer Protection.
What do you think we could be talking about financially?
Well, we are certainly talking about hundreds of millions of dollars and maybe over $1 billion every year out of the economy.
Nearly 3 years after CNBC's experts buzzed Adore Me off the segment, the FTC slapped the company with an order to pay $1.3 million back to customers.
They had a business where if you didn't buy each and every month, you could bank the amount that you weren't spending. What they failed to tell consumers is if you canceled the service, you lost all of that money that was essentially in your bank. There was no disclosure of that at all.
And that's not all.
They used one of the classic means of keeping people from canceling. They left them on hold for long amounts of time.
I had customers that called in, they were angry. They're like, I want out of my subscription now.
Gabrielle Augustin is a former customer service rep for Adore Me. Shanti Hernandez ran the department there for 3 years.
We've had people who were like just cursing and going crazy.
And she says many had no clue they were even signing up for a monthly charge. The VIP membership was pre-selected at checkout. Customers had to uncheck the box to opt out. And when she told management that customers were begging to cancel,
It was definitely like try to keep them at however you could.
Cassie LaForest was one of those customers calling in to get a refund after she ordered a bra and underwear set in 2015.
It wasn't comfortable, it wasn't soft. So it's kind of like, okay, so I wasted $25. I won't shop there again. At least that's what I thought.
Until she says her card got declined and realized that Adore Me had been charging hundreds of dollars and keeping her money as store credit.
You had no idea you were signing up for a membership?
None.
After last year's order, the FTC says Adore Me cleaned up its act. According to the order, Adore Me did not admit or deny any wrongdoing.
They did give the money back. They gave it to us in the form of a judgment in court.
The company did not respond to our repeated requests for comment.
To make sure you don't get locked into a plan, take your time at checkout and read every box so you aren't signing up for a monthly charge that you don't want. For Nightly Business Report, I'm Andrea Day.
Here's a look at the final numbers on Wall Street. The Dow was down about a point. It had been up more than 200. NASDAQ rose 63. S&P added 8.
That is Nightly Business Report for tonight. I'm Bill Griffith. Happy Thanksgiving, everybody.
Indeed. We will see you tomorrow.